live, the 𝐊𝐥𝐻𝐿 podcast. We're going to be talking pandemic today. I have my good friend Jeff Kleid from SoCal, who got all spiffied up, and he's got his pandemic helmet hair on, just like I do.
Like that?
Jeff? Yes, same. How you doing, Jeff?
That's how we roll. I'm doing great.
Good to hear. You and I had a quick conversation 2 weeks ago, and you dropped the bomb in the room when you said, I have a pandemic policy I just created and we're going live with. And I was just like, what, whoa, how's that even possible? No, that can't possibly be in this day and age. So I purposely decided not to interview you ahead of time and get all the particulars out. So I'm learning with the rest of the audience in terms of the particulars, but spill the beans. What is this product?
Well, so I mean, the simple math of it is it's a buyback, which now it's an exclude. Right now, pandemic coverage is excluded. It's been excluded, but at the same time, even in certain directions, it wasn't always excluded. And in fact, I think we're going to see a lot of stuff going across the board. Litigation's already happening, but in certain, what people don't realize in specialty insurance, there's always somebody always has sushi under the counter. Right? Somebody always has something that might be natural.
Did you say sushi?
Yeah, like sushi under the counter. Like when you go into a sushi place, everyone gets the normal stuff, but then if you get to know the guy at the front, hey, give me the good stuff, right? So
okay.
In insurance, in specialty insurance, it's the same thing. So, we launched about 2 weeks ago. I would call it a hybrid. I would say it's a parametric indemnity insurance for business interruption, extra expense, could be supply chain disruption. Interestingly enough, we've found a kind of a space within the film and TV industry because of my background. There's a few coverages specific in there, CAS coverage, civil authority, which is regulatory authority, right? Civil authority, and then imminent peril, which is where you end up having to do things to fix the problem that might be bigger, but you cause another problem in the process.
Yeah.
So, if you're familiar with that term, but they had the coverage, for example, but now they're excluding it as they're coming back to work to film. So it's interesting, that industry was already covering pandemic for film shoots and things like that, for viruses and things like that. At the same time, that I've been working closely for a couple of years because of my hemp and cannabis space with captives for a good couple of years, trying to figure out how to use them as traditional insurance for coverages that wouldn't exist normally, right?
Wow.
So it just so happens that one of the captive managers I've been working with for going on 2 years now, we were having a talk. This is probably 8 weeks ago now. And we were talking about, business interruption, and we were talking about all the stuff. And I was, 8 weeks ago, I was telling all my clients and friends, I'm like, look, I'm not going to tell you not to file the claim. Most likely it's excluded because it says it's excluded. But last thing I would want to do as an agent is tell you, no, don't move forward to the next step, because I don't know what's going on. I said, and sure enough, the minute I started saying that, you start seeing the news, states are getting upset and everyone's getting upset. Anyway, I personally think that how do you not create at least a solution that can help start to get to the next level so that the industry wants to feel comfortable of getting back? The difference is, though, where business interruption and extra expense was just like this throw in that was, hey, by the way, you have this, and really didn't have any defined terms. That's where, using a parametric thought process, it's a fixed moment in time. It doesn't have to be a direct, exposure. It has all these things. So if you use some of those markings, we decided that we would do it. And so one of the things that my captive, partner was doing already was he's already been covering supply chain disruption, business interruption, all these things
for other perils.
For accounts he already has.
Yes. Okay.
Like he's already been paying it for this pandemic. No, for this pandemic, he's been paying claims. But so I'll give you an example. Take, most people, not most people, a lot of us did, a lot of us didn't, some of us didn't, but the the PPP and the SBA loan and all that other stuff, if you think about it, if you have pandemic coverage, or if you already had it in place, that's going to be a way to take away and knock down that claim, right? So if someone got PPP coverage, they're going to end up, let's say let's say it's a medical officer, a lawyer, law firm, multiple law firms, and they got, let's say they, and let's use a medical office, like not with what's going on, but like a normal surgical center, someone has vanity work done, right? Let's say the surgical center has multiple locations and they, already had this pandemic coverage in place. Well, you're going to look at, okay, how many clients did you lose? How many clients are going to reschedule, right? Because that's going to offset the amount of your loss for business interruption, right?
Yep.
Do you have to keep paying your employees? No. So your extra expense is getting minimized.
But they should.
Well, they should, but they're not going to, and you and I are going to lose that battle. Yeah. So, okay. My people are all still working. I've been trying, because we still have to service even prospects that are trying to buy policies. So we had to figure it out, and I couldn't figure it out. I mean, I had to pivot along with everyone else. But at the same time, these are great. We've created a Band-Aid that we hope, if we do it right, we have enough people insured to get the few things that they need. And we looked at it, very uniquely. We looked at it and said, okay, people are now in probably the best risk management, risk mitigation space they've ever been, because they have to be, right? In order to open your doors, when you open back up, here's the criteria for what you have to do, right? Then if you're able to open back up, here's the criteria for how someone can come into your establishment, right? That's another set of criteria. Now somebody says, okay, we've got that down, but now what happens if we get shut down? What is it really going to do? Is our reputation going to be penalized? Maybe, because people aren't going to want to go shop there anymore, or people aren't going to want to go eat there. So we threw in we created a throw-in for reputation repair as like a crisis response. So it's an instant throw-in, and you do it because, yes, it's free money that you're paying, for that part of the claim, but you're also hoping that it gets them back in business again. And we also then looked at, okay, forget about what last June was as it relates to this June when you reopen, or August or July. What are your sales projected to be? And the good news is you can really figure out these things, because people that are, in every industry, they're trying to figure out in general, right? So you'll have some guideline. You won't have their specifics, but if you set parameters, so our coverages range, the minimum coverage is 500,000 in coverage. So far, the maximum we're willing to go is about 3 million. We prefer multiple locations because it gives us a chance to both spread the risk and put a fixed number per location. But at the same time, I think it has real legs. So that's where we're at.
So how does the parametric trigger work? What actually, what outside force actually causes it to kind of kick and start?
Well, and so that's where it's funny, because I don't want to get pigeonholed as a parametric play. I want to explain, though. So clearly, if they have another civil authority or regulatory authority shut down, once they're reopened and that business is able to be doing what they're doing based on the criteria they've met, that's a trigger.
Yeah.
Okay? It's a valid trigger. Now, where it differs from parametric, and this is why I don't want to have a conversation ideology-wise with a bunch of insurtech people. At the same time, I don't want to have an ideology with a bunch of insurance brokers, because the brokers will say, well, how can you use a captive model? No, we're not going to do that. That's, we don't make enough commission. I'm like, look, you want to help the client? This is what you're going to do. And you want to focus on parametric? No, we can't. There's no true, I've had people say to me, like a couple of people say, well, there's not supposed, it's an indirect loss for parametric. It shouldn't be a trigger. Like, there shouldn't be a real loss. It's just, if it damages because of this, then we get paid. I'm like, well, we've been doing it for a couple of years in the hemp space, where if you get hail and it's this big, we then tell you it was that big, so you should get this payout, but you still have to tell us, yes, we really had that loss. So it's a little different than a true parametric play. Then take, for example, for entertainment, take cast coverage, all right? cast coverage is a direct loss because you lost somebody, but it's because someone else got sick. So it's because one of the key members of the cast gets sick. So there is a direct loss, but indirectly, this is why it's a parametric play. The trigger is someone got sick and they can't come back. And because they can't come back, these guys have to shift. But here's the other side of why it makes sense. Because that film company, I mean, think about it this way, and this is the way I think it's going to happen in every industry. Like I had a conversation in the event space yesterday, because I think this same, each industry is really looking at their stuff going,
Yep.
This is what I need to do. But so for the film industry, just as an example, you've got SAG, Screen Actors Guild, you've got AFTRA, then you've got the extras, you've got the, I'm sure, you've got the state, or you've got the municipality, you've got the studio, you've got the country, right? So you've got all those people putting criteria on these guys. So I've got to believe, and in a perfect world, I would never have believed this before, but in the film space, they've always been very intentional on how they're going to shoot each day. So I've got to believe, and I do believe this to be true, that they've figured out, okay, if this, then that, right? Mm-hmm. They're doing that because they've gone under the assumption that this coverage no longer exists. So now that they've gone under that assumption, now they decide, okay, we do want the coverage. Yes, it's expensive. It wasn't really a throw-in like it used to be. Now it's an exclusion that we're buying back, but we'd still like to have it, especially on the smaller stuff. And this is why it works for that space. This is why I think it's going to work for example, we have a couple of hotel chains that we've just presented quotes on. And they're small, closely held hotel chains. One happens to have, they happen to focus on, they're like, I don't know how to explain it, but they're, on the highways. They're the hotels on the highways, and they're there, and they have big government contracts for people fixing the roads and stuff, right? So clearly they lost a lot of business. If they still have their contracts in place, once that deploys, we'll have an accurate assessment as to what they'll have to lose if they have to get shut down again. We have a fixed understanding of what the extra expense would be to clean the hotel if there's COVID again, right? If the relapse happens. At the same time, everybody has to manage their expectations, and this with your hard to place insurance background and what you guys do, with your flood, like. You're basically giving them a fixed moment in time. You're like, okay, so we're going to give you $2 million in coverage to cover your 20 hotels. We're going to give you $100,000 per location. And if you've got 5 locations that do better, if you want to do, 100 on 10 of them, 50 on 5 of them, and 200 on the other ones, we're customizing each policy.
Okay.
So it's a start. It's a start though.
And that's when I did a couple of episodes on captives, and I specifically talked about captives in regard to pandemics. I saw this as a very unique opportunity because obviously the demand is going to be there, right? And so with that much demand, you can craft your capacity any way you want to manage the risk. That was the beauty of it. You don't have to specifically make it this all-encompassing thing. As you decided, you went the tact of it can keep our policy limit to a certain window, and even in the policy limit we can have per risk limits as well. So you can do a lot to sort of manage the risk and tally all that up to say, okay, we sold 100 policies. Here's our overall aggregate exposure, and to top it all off, the cherry on the cake here, with all of that demand, you get your rate. You can actually do the modeling and get the price that you think or more that you want or need to actually make this successful.
Right. And the other side of that is what's unique about this for us is because I've been working with this captive manager for a couple of years, we're actually offering it also as a first dollar insurance policy. So we have both sides of the world. We're using the captive to kind of build around it, but the uniquity of this captive system is it's first of all, it's based out of North Carolina. And so it's admitted, it's domiciled here in the States, and it makes sense. But it's also pooling a bunch of reinsurers together And the way they're doing it is no one reinsurer is on the hook for more than a couple to 3%. So it allows us to take on these risks, but also it allows somebody who's bigger and stronger that wants to go into the captive space. They don't have to put up their own capital. What they're doing is they're putting up capital and premium, but they're putting it up as if it's premium because it's the fixed amount. So they don't have to come up with more capital on the backside with the way we've set this up.
Okay, so since it's a captive structure, for those that want to participate in this and they have good claims, because it's captive, are they now participating in the ownership of the captive?
They can. So there's two arms. So absolutely, they can. The problem for most people is, our minimum, starts at $50,000. Okay. And we're able to, for $50,000, and it starts at 50, but, we could be talking about coverage between anywhere from, $450 to $600,000, $700,000 for that 50 grand. Right. But the reality is we know that people are going to be more in the 1 to 2 million range. Right. It's just how they're going to do it. But at the same time, they can either, with those dollars that they put up, if they have multiple locations, it makes sense because they're putting up the premium. They're either forming a captive cell where they're participating, but they're not, but their participation is built into what we've done with our actuaries to figure out what the pricing is. So they, the expense, setup expense and all the other stuff is included. It's not outside of it. And then basically they're just buying insurance, and it's been, their portion is the first amount that goes in if there's a claim, but that portion is part of what they've already paid. So it's different than a traditional captive where you put up a deposit, you then go through the process, you put up your premium, then you have a claim, and then you're responsible for half of it, right? So it's usually reinsured in half, and then you're responsible for half. It's different than that. It's truly $1 coverage, and it's truly based on that. And then we are also, with all the quotes that we have out there right now that we think are going to close, and we've only been up and running for about 10 days. I mean, honestly, like it took us we started talking about 8 weeks ago. I was, and here's the funny part. I'm a blue state guy. The person with the money is a red state guy. So we had a great chance to meet in the middle and actually figure out what's the best for underwriting rather than politics. Right. So it's a really good fit for how we're doing it. And we started coming up with all these criteria for when it was going to trigger, like how is it going to happen? And, like, for example, we were originally thinking, okay, when everything opens in August or September, it's going to be the relapse. Well, now, everything's going to be up and running in 30 days. So there's the relapse. Right. So we went through a whole bunch of stuff, and it's only been, about 10 days ago that we finally fine-tuned it with each, because it's still custom, we fine-tuned it with certain directions. So we feel good about the hotel direction, the retail when they reopen direction, and the film and entertainment direction. And I think we're going to get into some other, we have other directions that I'm working with, but I don't want to say because they're from specific agents, right?
Okay. That was going to be like my next question was, how do people get in? Is this going to be a D2C? Or you brought up agents. Is that the model that you're going after, is expecting that agents and brokers are going to bring you the business?
So we're, me, I'm a hybrid, right? So I've always been a retail guy, but I launched Elite Risk again a couple of years ago after my non-compete was up with Aon, from the last program I sold them, as an intermediary, as an MGA. That was where we set ourselves. The problem is, I want to get coverage to the end user client. Yeah. In a lot of cases, without offending my fellow agents, their agencies are restrictive in letting them do things if they don't make enough commission. Right. And so it really causes a struggle because we can't build in a lot of commission for everybody, because if we do, the price is already starting high. Like, we're just trying to get this thing sold. So that makes it tough. I do have a few select agents that understand the terms. They've embraced it. And quite frankly, I could probably like specific to the entertainment space is a perfect example. This. I mean, that's my background. I know a lot of entertainment people. A lot of entertainment insurance agents worked for me over the years, and they still like me. So I could go to them. The problem is the agencies they're with, they're not flexible. They're not bendy. They're not whatever. They'd rather sit and complain about what isn't available than give something. And it's always been the case. That's why we were so successful when we built my first agency into an entertainment agency. So yeah, I'm open to whoever has a need for their client. We have limited capacity. I will tell you that right now. I mean, we don't know what that capacity number is. I do know that I have.
You're basically saying first come, first serve. Like
it's kind of like that.
The barrel could run dry.
Yes, but here's the best part. I think, and here's where we really benefit is my captive manager has a really unique structure that allows us to scale up in a unique way. And so, really, if there's anyone out there, like if there's anyone out there that, is multiple reinsurers, like here's what I see beyond Jeff. Okay. I'll tell you what I see for the fix for this industry. And it's funny, and I'm going to throw out Patrick Callahan's name because Patrick, saw one of my posts, and Patrick clearly. So
Insurance Elephant.
Yeah, the Insurance Elephant. So he saw one of my posts, and he's like, Jeff, here I am, like, working like a madman on this white paper and doing all this stuff, and it looks like you did it. And so we started this great conversation, and because of you, I met him, and because of you, I met him in Hartford when I was there. But he was like, we were talking about it, and he's looking at the macro scale, and I'm looking at the, just selling policies, boots on the ground, doing what we need to do. But really, they're the same logic. Where I see this playing. So here's how I see this playing out. And I don't want to get caught up in InsurTech or sales guys or whatever, but this is truly a blockchain parametric hybrid indemnity play that if there's enough either reinsurers or private equity that puts a certain amount of fixed funds into a pot of their choice, and then that pot and then they have the ability to say yes or no automatically to whether they want a certain risk based on certain criteria. And I'm talking about this in real time, not necessarily like having to think about it, right? There is truly a way to create a quasi ILS play for this using blockchain, and basically creating a digital ledger that people can put in as much as they want. And I always explain it to people this way because I've talked about blockchain for a while, even though I'm not I know it's sexy, but it's not functional for most stuff in insurance. So let me just say that it's not functional for most things yet. But it does have true function for this, because if you can visualize a Brazilian steakhouse when they cut the little meat, right? And they come back with another piece of little meat, and then they come with another piece of little meat. If you think about it like that, if you created a component where even if we created something to give someone who wants to take a little risk, let's say it's $1 million. Let's say it's just $1 million, right? One reinsurer wants to take $1 million risk. But of that $1 million risk, they want it to be spread out to 10 different risks. Okay, so they're like, okay, we agree to put $100,000 into this, right? And I know it sounds silly, but if you have 10 of those, and you now have $10 million, and each one of them is willing to put $100,000 into any one of these COVID relapse policies, that client has $1 million, and quite frankly, the investor's only taking 10% of the risk. Right? It's a very simple math, simple mechanics, simple dollar, and you can start working through Main Street USA that way, because we can get lower numbers. We can now, through my end, that's why I say they can go and get a captive started, but we also I've been given the ability to sell these directly, where it's just them paying premium and they don't have to get caught up in it. Because some of these guys, like for example, on the entertainment side, they don't want captives. They just want to get insurance for that 1 3-week shooting period, right? Yeah. So they don't want to deal with, well, I'm not going to spend it next year. I'm not going to manage a captive. I don't want to pay captive fees. I just want to pay my premium. So we have that ability. We've set that up for me to have that ability. But I see this as a totally scalable thing. But I say that, but I also don't want to be the guy that spends the next 3 years talking about this scalable thing. So we're just selling insurance. Yeah. Like that, that's what we're doing. But it
So
makes sense if you think about it.
yeah. So is it where should I direct people to for this elite risk? I know you. I will have connections to you in the show notes.
Have them email me or call me.
Should they go to Elite Risk as well if they want to learn more without the pressure of salesman Jeff selling to them?
So I mean, this is how. Again, this is where I'm different than some people. Like we don't even, I've got 2 flyers I put together that are like literally it's one flyer and then I ran out of space, so it's the second page. It's nothing sexy. Like I haven't stopped the bus to market it. I'm boots on the ground, grassroots. I've done nine quotes as of now.
In 10 days.
In 10 days, but they're at some big.
Started.
There's some big players that are like, it's not even that they're saying no, it's that, well, we're still in the middle of doing this and we're doing that. So yeah, I mean, I haven't had time, and I don't want to take the time to go put it out there. And like, I pop in on LinkedIn, you know me, I kind of just,
I'm your marketing.
Yeah, no, you're doing a great, no, you're doing a great job. And so that's why I say, just come to me.
Okay.
It's not that I'm trying to sell you. It's really, and by the way, I'm not even trying to sell anybody. It's simple. It's expensive. It's for multiple locations. It's for someone who is okay accepting that their expectations are, they don't get free business interruption and extra expense anymore. Because think about it. They had free business interruption and extra expense. How'd that go? So it's not cheap. It's not free, but it's going to pay out. So that's what you want. Right. So yeah, it is about coming to me, and it's not about me trying to sell you on it. If you call me and you say it's too expensive, don't call me again. It's really simple. Like I can't make it any easier.
Yeah. So I will have your connection information in the show notes. So for anyone that's listening, you don't have to scribble it down. Just go to the show notes. You can get the transcription of this conversation. You can watch, listen,
I really need to do that, by the way.
Check out Jeff's helmet hair. And all of that. Hey, Jeff, congratulations on the product. Thanks for making a dent in the insurance universe, and best of luck.
Thanks, man. Thanks. I appreciate it.
Okay.
And so, my fellow Americans, ask not what your country can do for you. Ask what you can do for your country.